The luxury goods sector, which has sailed through the crisis more easily than most, is now feeling the heat. Growth in China and other key markets is slowing, so how worried should investors be? With me now is James Bevan, Managing Director at CCLA Investments. James, as you know, Burberry shares have tanked about 20% this week and the company blamed the external outlook. Can all this be blamed on China?
I don't think so. I think that Burberry reported a wide-scale downtrend in demand for their products, and that really largely reflects the reality that Burberry is slightly on the cusp of being luxury, and therefore investors who want to be focused on luxury goods and the defensive qualities need to think about what's really safe, what's really stable, and therefore what can really deliver in an economic climate that's likely to remain very tricky.
But as I said in the intro there, the sector itself is feeling a bit top-heavy. What if we do have a hard landing in China?
I think there's every probability there will be a relatively hard landing in China, but I think what's very evident is that the top end of the market continues to buy. It's the lower market participants who are much more economically sensitive. And therefore, when one thinks about which companies are relatively well placed to continue to do well during a relatively difficult economic period, I think you have to look at companies such as Hugo Boss and such as LVMH, both of which I think have very defensive characteristics and are well placed to do well in the period ahead.
What are those characteristics?
Well, in the case of LVMH, it's really the Vuitton core business. There we see a very credible sales strategy. We see very strong long-term margins built on a brand that is recognised as extremely desirable by the top end of the economic participants. In the case of other companies, I think that the challenge really is to make sure that you are a must-have product. In the case of Hugo Boss, it's the American suit business where margins have been able to be maintained most, therefore divorcing the company from some of the real problems facing companies dependent on middle market China.
Would the investor be wise to look at companies that offer a specific product, for example, just clothes, perhaps like Boss, or a luxury goods company that does the whole range, clothes, watches, champagne, for example?
I think the problem with champagne is it is a very cyclical business. It's very clear that the demand for champagne is not impervious, given that it is now a mass market product, to an economic headwind. And I think that therefore what one has to contemplate is much more the nature of the company, its valuation and its management. If you take, for example, PPR as a group, which obviously includes Gucci and also Puma, many people have said, look at the numbers, they've been absolutely fantastic, and they have. The problem I have with that company is that at a 30% margin on the core Gucci business, I see nothing but bad news ahead. And I do think that the share price PPR may therefore fall back to around about 115 euros.
Are we being a bit too sceptical here? I mean, there are tens, hundreds of millions of very wealthy people in China and other emerging economies. Surely demand for these products is just going to grow and grow.
Well, there are three things to consider. The first of all, what's happening to sales. Secondly, what's happening to margins. And thirdly, what's already in the share price. Now, on the question of sales, a lot of the good news is already baked into analyst estimates. And I therefore do think that there is some downside risks. On margins, the real challenge here is how do you grow a business? How do you actually get more footfall? How do you push your product into the margin? And the hard reality is it takes a lot of investment. And I think for companies that want to grow, that means lower margins in the period ahead and therefore potentially bad news for net profits. The third issue is what's in the share price. And the share price of many of these companies is very rich. I have a target share price for LVMH of 150 euros. Now, that to me still allows a reasonable margin for error. For other companies, however, I don't see that margin for error, and therefore I see some downside risk.
OK, James, thank you very much. My thanks there to CCLA's James Bevan. I'm Jamie McGeever. This is Reuters.